Top 20 Equity Research Analyst Interview Questions and Answers. Are you preparing for an Equity Research Analyst interview? You're in the right place. Whether you're applying to a top investment bank or a boutique research firm, the interview process will test your financial knowledge, analytical thinking, and communication skills. Employers want to know if you can understand businesses, build financial models, and present compelling investment ideas. This guide walks you through the most common and most important interview questions you'll face, with clear, concise answers that will help you stand out. Let's dive into the 20 key questions you must master before your next equity research interview. 1. What does an equity research analyst do? An equity research analyst analyzes publicly traded companies to give investment recommendations. They study financial statements, monitor market trends, speak to company management, and build financial models. Their goal is to determine whether a stock is under or overvalued and advise clients accordingly. Analysts typically publish reports detailing their findings and ratings, buy, sell, or hold. This job requires both deep financial knowledge and clear communication skills. Analysts may specialize by sector, like tech or healthcare. Successful analysts can influence millions in trades with a single report, making the role both challenging and highly impactful in financial markets. 2. How do you value a company? Valuing a company involves several methods, but the most common are discounted cash flow, DCF, comparable company analysis, and precedent transactions. DCF projects a firm's future cash flows and discounts them to present value. Comparable company analysis compares the company's metrics with similar firms in the industry. Precedent transactions look at past M&A deals in the same space. Each method has pros and cons, and analysts often triangulate among them. Understanding the business model, growth potential, and risks is essential. Analysts also adjust for economic conditions and industry trends, aiming to arrive at a fair, defendable valuation. 3. What's in a research report? A typical equity research report includes an executive summary, investment thesis, valuation, risks, and financial forecasts. The report starts with a clear recommendation: buy, sell, or hold, followed by supporting analysis. It includes financial models like income statements and discounted cash flows, as well as charts and tables. Sector overviews and competitive positioning are also key. Analysts must distill complex financial data into readable, persuasive insights. The goal is not just accuracy but influence. Clients use these reports to make trading decisions. Clarity, credibility, and consistency are crucial in producing reports that impact investment choices. 4. How do you stay updated on the market? Equity research analysts use financial news outlets, earnings calls, investor presentations, and data terminals like Bloomberg or Reuters. Staying current means reading daily updates, monitoring stock movements, and understanding macroeconomic trends. Analysts subscribe to industry newsletters and attend conferences to gain deeper insights. It's not just about consuming information, it's about filtering the noise and identifying what matters. Good analysts also follow thought leaders, talk to company insiders, and track earnings surprises or regulatory news. Staying updated helps analysts adjust models and revise recommendations swiftly, which is vital in fast-moving equity markets. 5. What is a discounted cash flow (DCF) model? A DCF model estimates a company's value based on its future free cash flows, discounted back to present value using a chosen discount rate. Analysts forecast the company's revenues, operating costs, capital expenditures, and changes in working capital. The model includes a terminal value to account for value beyond the forecast period. The weighted average cost of capital (WACC) is commonly used as the discount rate. A DCF is sensitive to assumptions like growth rates and margins. It's detailed but powerful. When built well, it captures the intrinsic value of a company regardless of market sentiment. 6. What is WACC and why is it important? WACC, or weighted average cost of capital, is the average rate a company is expected to pay its investors, both equity and debt holders. It reflects the riskiness of the business and is used as the discount rate in DCF models. A lower WACC means the company can generate value more easily. A higher WACC means more risk. It balances cost of debt, after tax, and cost of equity, weighted by their proportion in the company's capital structure. WACC is essential in valuation. If a company earns returns higher than its WACC, it's creating value. 7. How do you analyze a company's financial health? To evaluate a company's financial health, analysts review key financial statements, the income statement, balance sheet, and cash flow statement. They assess profitability through margins, efficiency through return ratios, liquidity via current ratio, and leverage using debt metrics. Trends over time reveal consistency or volatility. Analysts also compare metrics to peers and industry benchmarks. Cash flow quality, debt servicing ability, and asset utilization offer deeper insights. Non-financial factors like customer concentration or legal risks are also considered. A comprehensive analysis helps determine the company's risk profile and potential for long-term value creation. 8. What is the difference between buy-side and sell-side? Sell-side analysts work for investment banks and brokerages, publishing research for clients and generating trading activity. Their reports are public and often cover many companies. Buy-side analysts, on the other hand, work for asset managers, hedge funds, or pension funds. Their research is proprietary, aiming to inform internal investment decisions. While both roles involve deep analysis, the buy-side has fewer coverage responsibilities but more accountability for investment outcomes. Sell-side analysts focus on relationships and visibility, while buy-side analysts focus on performance. Each side requires a unique mindset but shares similar analytical skills. 9. How would you analyze a tech company versus a utility? Tech companies are growth-oriented with intangible assets and rapid innovation. Analysts focus on revenue growth, user metrics, product roadmap, and scalability. Valuation often includes forward-looking multiples like EV/sales or a DCF with aggressive growth assumptions. For utilities, stability and dividends are key. Analysts emphasize regulatory environment, capital expenditures, and debt levels. Valuation relies more on dividend discount models and predictable cash flows. The differences in risk, cash generation, and regulation drive very different analytical approaches. Understanding the industry context is critical for accurate valuation and effective investment recommendations. 10. How do you pitch a stock? Pitching a stock involves a clear, structured argument backed by solid analysis. Start with the name, ticker, and a strong investment thesis. Why this stock? Why now? Then provide supporting details, valuation, growth drivers, financial performance, and industry trends. Highlight key risks and how they are mitigated. Include a target price and time frame. The pitch must be concise yet persuasive. Use visuals or summaries if presenting. Your ability to connect the company's story to investor returns sets you apart. A great pitch shows both analytical depth and storytelling clarity. 11. What are key metrics you track daily? Daily metrics include stock price movements, trading volume, sector indices, economic indicators, and news updates. For coverage companies, analysts monitor price targets versus actuals, earnings revisions, and analyst upgrades or downgrades. Key financial ratios like PE, EV/EBITDA, and debt to equity are watched for sudden shifts. Macro indicators like interest rates, inflation, and oil prices can also influence valuations. Monitoring sentiment, insider activity, and unusual options trading provides additional insight. These metrics help analysts stay alert and quickly respond to new developments affecting their coverage universe. 12. How do you assess industry trends? Industry trends are analyzed through market research, financial reports, trade publications, and expert interviews. Analysts study revenue growth rates, customer behavior, and emerging technologies. They monitor regulatory developments and global shifts like supply chain changes or ESG concerns. Peer comparison is vital. Understanding how different players adapt helps assess competitive advantage. Analysts also track M&A activity and capital flows into the sector. A well-informed industry outlook helps shape forecasts and recommendations, making trend analysis a core part of research. 13. What makes a good equity research analyst? A great analyst is curious, detail-oriented, and skeptical. They combine strong financial modeling with business intuition. Communication skills are critical. They must explain complex ideas clearly. They stay organized, manage deadlines, and handle multiple companies or projects at once. Integrity matters. Their reputation is built on accurate, unbiased insights. Great analysts adapt quickly, learn from mistakes, and stay updated on industries and markets. Relationships with management, clients, and internal teams also set them apart. It's a demanding role, but top analysts influence investment decisions and build long, successful careers. 14. How do you handle a missed forecast? When a forecast misses, transparency is key. Analysts reassess the model, identify what went wrong. Was it margins, revenue, or one-time items? They update assumptions, revise the report, and clearly explain changes. It's crucial to learn from the mistake and avoid emotional bias. Credibility depends on consistency, not perfection. If external factors caused the miss, that context should be communicated. Good analysts manage expectations and adapt quickly. A forecast miss is not a failure. It's an opportunity to refine analysis and build trust through honest, thoughtful revisions. 15. What is beta and why does it matter? Beta measures a stock's volatility relative to the overall market. A beta of 1 means the stock moves in line with the market. Above 1 means more volatile. Below 1 means less. It helps assess risk and is a key input in calculating cost of equity through the capital asset pricing model, CAPM. A higher beta suggests higher expected returns, but also more risk. For analysts, understanding beta helps align stock recommendations with investors' risk profiles. It also affects valuation through discount rates and portfolio construction decisions. 16. Describe a time you made a bad call. Everyone makes mistakes. What matters is the response. A strong example involves owning the mistake, analyzing why it happened, and adjusting your process. For instance, underestimating competitive pricing pressure might have caused a too optimistic forecast. After reviewing data and speaking with management, you updated your model and published a revised view. Sharing this openly helped rebuild credibility. Lessons included better scenario planning and improved industry checks. Showing how you adapted proves maturity, integrity, and growth, a key trait for any analyst. 17. How do you manage deadlines with multiple reports? Time management is crucial. Analysts prioritize reports by earnings calendars, client impact, and news sensitivity. They maintain a content calendar and block time for research, modeling, and writing. Breaking work into stages, data gathering, analysis, writing keeps progress steady. When deadlines clash, they delegate tasks or work with associates. Communication with managers and sales teams helps align expectations. Successful analysts deliver timely, accurate work without sacrificing quality. Organization tools and discipline are your best allies in high-pressure environments. 18. How important is communication in this role? Extremely important. Analysts must explain complex financial insights to clients, colleagues, and even media. Clarity, brevity, and storytelling matter. Whether writing reports, presenting stock pitches, or answering client calls, communication is central. It's not just about data, it's about why it matters and what to do about it. Good communication builds credibility and trust. It also ensures that your insights are understood and acted upon. Writing and speaking clearly is just as important as crunching numbers. Both skills must be strong to excel in equity research. 19. What happens after you publish a report? After publishing, analysts engage with clients, respond to questions, and track stock performance. Sales teams distribute the report, and clients may request follow-up calls. If the report moves markets, media may pick it up. Analysts also monitor how assumptions hold up. If earnings disappoint or a new development occurs, a quick update may be required. Feedback from clients helps refine future research. Reports are not static, they evolve with new data. Publishing is just one step in a broader dialogue with investors. 20. Why do you want to work in equity research? Equity research offers a unique blend of analytical rigor, business insight, and market influence. It's a chance to dive deep into companies, shape investment views, and stay close to the action. You enjoy financial modeling, thinking strategically, and explaining complex stories clearly. It's intellectually rewarding and constantly evolving. You value the impact your research can have and the relationships built with clients. Whether it's forecasting tech trends or assessing risks in emerging markets, equity research is a dynamic field that matches your curiosity and ambition. Conclusion: preparing for an equity research interview means more than memorizing formulas. It's about showing that you can think critically, analyze deeply, and communicate clearly. Each question tests a different part of the analyst mindset: financial knowledge, industry understanding, strategic thinking, and presentation skills. Use these 20 questions to shape your preparation and highlight your strengths. Remember, your insights can influence real investment decisions. With solid preparation and confidence, you'll be ready to impress your interviewers and take the next step in your finance career.